All righty. Good morning, traders. This is Blake Morrow, and it is early. It's, it's, it's early. It's early, and it's Good Friday, and it's a holiday here. I don't know what I'm doing up at 3 o'clock in the morning on a Friday, on Good Friday. Still trying to figure that one out.
Every
Excuse
Friday
me.
is good.
What?
Every Friday
What?
is good.
Every Friday is good, but the rest of my city probably won't be awake for a few hours. I'm gonna grab a drink of my coffee really quick. Hold on. Okay. Let's see here. Okay. Glasses check. Coffee check. Morning check. Everybody's around check. Okay. So good morning, Steve. How you doing? Or good afternoon for you, I guess. You know, it's always weird. Whenever
I'm good,
you
mate.
guys in Greece, if I say good morning, and it's actually, what time is it there? It is noon.
3.
It's 3 in the afternoon.
1500 hours. Yes.
It's 3 o'clock in the afternoon, and I say good morning, and but for you, it's almost like it is kind of morning. What time? When does it turn afternoon for you?
For us Greeks, I would say at around 4.
Yeah, right. Because it's weird. I say that, and it's like the only reason why I say that is like, in the United States, it's like, okay, well, between the hours of 6 a.m. and noon is morning, and then after 12 o'clock it's afternoon, right? But in Europe, the day seems to start so much later. Well, at least in Greece, and I'm speaking for mostly Greece and probably more of the. But anyway, that's neither here nor there. It's just, but it's interesting when I say good morning and it's 3 o'clock in the afternoon, and you guys actually think it's kind of like morning there, maybe. But Stelios, you might be a little bit different. What time do your kids go to
I
sleep?
don't think, it applies to Stelios. He wakes up like at 6, 7 in the morning.
So
Yeah, 7.
you have a normal life. I
Yeah.
call it normal because it's my normal, I guess, is what I would say. All right. Well, hey, glad you guys could make it. Apparently, Dale, I don't blame Dale for not being here. He said if I wake up and I'm like, yeah, he's probably not. So
I wouldn't if I was him.
yeah, why not? If you don't have to be around and you can just kind of avoid the price action today, why not? And I'm glad that some of you guys are here today, because I do think that the market's going to be we're going to see a little bit of volatility. Didier said it's 7 p.m. here. You should be on the golf course, right? That's where you should be. Yeah. I was just going to say that we might see a little bit of volatility, but then it should immediately die out or just grind in whatever direction it's going to go. But I want to talk a little bit about today's data and what we're looking for. So if you look at what expectations are for the jobs report, the market's looking at. This is 650,000 investing. Let's see if investing's around the same. Investing.com's looking for 575. No. I'm sorry. Same number. Hold on. I'm going to check one other location really quick. 652 from Forex Factory, and then I'm gonna say that there are whisper numbers that are looking towards a million jobs created. So the reason why I think this is important to understand is because this is a different function that we've seen in recent months. It's going to be different now for non-farm payroll. And the reason why I say that is because data does matter. Gregorios said, "Who cares about data anymore? Non-event, you will see today." I actually, the only reason why it could be a non-event is just because of the lack of participation. But I actually think the data does matter, and as I've been saying for this year, data points are actually moving the markets. Why is that? because when everybody's at zero, now everybody starts to look at what's going to move the needle, what's going to make the markets move, or excuse me, what's going to make what's going to make the Fed or any other central bank move, and that's going to be data. Because if data continues to improve, like let's say we have just blowout numbers, which I think is quite possible. I think it's, it's possible we do create 750,000 jobs, maybe 1 million jobs. So you see this aggressive bounce back in jobs. Well, what's going to happen with yields? Yields have already been climbing, and yields are going to rip higher, and that's the market's function of forcing the Fed to quite possibly start talking about tapering. And if that happens, we might start hearing taper talk going into the end of this year, like into October, November, December. And if that's the case, then you're going to start to see the dollar move. So here's the thing. Central banks are now going to be forced by economic data to actually come to their senses, if you will, to be a little bit more hawkish, to start to prepare the markets for liftoff from being zero bound. And when you look at, here, one of the things that I think, and I try to think about this, a lot. Well, I think about it a lot, but it's the thing that really has me here is, and I know I've talked about this a little bit over the last couple of days, the aggressive posturing and positioning of the market going into the beginning of this year. So when you have and let's just go to the dollar. When you had, the market aggressively short dollars, long euros, biggest positioning we've seen, in years and years. And the market was aggressively short the dollar going into this year. And you can see all of 2021, we've actually reversed. We are very close to highs of the year in the dollar index. That trend could continue, especially today. You got a strong piece of data today. Not only is it good for the dollar could rally, but it's also bad for stocks. It's bad for stocks in a couple of different reasons, because if the stock market would actually come down because or futures would come down. Now, let's not ignore the fact that we are up at all-time highs. So, how big of a setback are we going to see in stocks? Probably not a lot. And it's hard for me to be bearish the stock market while we're above 4,000. But I will say this, the reaction to today's data, futures might come down a little bit following the data, because the market will say, oh, wow, the Fed, here we go. They're going to start, talking about tapering bond purchases, and we're going to see a more hawkish Fed because of this blowout number. Stocks will come down as a result. The dollar would actually firm as a result. Now, the positioning is so skewed, and still is, towards being a dollar bear, that we could see, a dollar bear. We could see a further drop in the euro down towards support, which would be, in my opinion, look at the very shallow bounces that you're seeing. This is pretty wild to me, and it still remains a wild dynamic that we're seeing in the markets. We're seeing markets at all-time highs, yet, the Australian dollar, the Kiwi dollar, the euro can't get out of its own way. The Aussie, we are literally only 60 pips off of the head and shoulder neckline. We're trading heavy, extremely heavy. You would think if, the Dow's at all-time highs, the S&P's at all-time highs, that the Aussie, the Kiwi, the Canadian, we would be ripping higher in these currencies, but we're not. That price action, there's something to be said for that. There is. We're seeing a massive divergence between what, these commodity currencies and even emerging market currencies. Yeah, the dollar Mexican peso has been, has been stronger the last couple of days as we've hit all-time highs in equities. Of course it has. Search for yield, especially in the currency market. You're going to be, trying to move over to some of these emerging market currencies to capture a higher yield. But look at this base that we've really forged out for the last 5 or 6 months as the stock market hits new highs. You can't argue with that. You just can't. And if stocks come down, you're going to see currencies like the US dollar Mexican peso. And when I say come down, I'm only talking like you see a 8 to 10%, 12% correction in equities. This dollar Mexican peso is going to be trading back in the mid 20s. The Aussie dollar will be trading down here at 71, 72 cents. Dollar Canadian will be trading back at 130. So, you got to be cognizant of the fact that these currencies, and like here's a the dollar Canadian trying to come out of the wedge. We could also build out an inverted head and shoulder pattern here, right? So the shoulder, head. Anyway, just some food for thought, especially in a day where the market is actually looking for a strong number. We're looking to create 650,000 jobs, and there's some whisper numbers that are well above that, closer to 1 million. So just keep that in mind. So Steve and Stelios, good morning, guys. Do you have any comments that you'd like to make regarding what I was just talking about?
Good morning.
Good morning.
I have very little to say today. It's been very slow and nothing's really changed since yesterday. So I agree with you on the fact that data is going to start to matter. It hasn't mattered for a long while, but it's going to start to matter. And you talked about the taper word, the T word. If that gets mentioned at all, then I think the market's going to start getting pretty shaky. But at the moment, nothing has changed. Nothing is new. We're waiting for another number, which might come in strong, might not. Unfortunately, I don't see anything materially different to what we've had for the past weeks and months. And I do realize the dollar is rallying this year. And you remember, for weeks now, for months now, we've been saying, look, it's ripe for a rally. And I've been saying I think it's going to hit 96 on DXY before it goes down again. And we are seeing this move, or part of it, move manifest, but I don't. Unfortunately, for me, who I don't trade intraday, I have very little to do. Unfortunately.
Yeah. So, well, okay. So and Steve, I didn't want to cut you off here, but let's talk about today and potential price action here, because the reaction from a strong non-farm payroll, you get a strong jobs number. The knee-jerk reaction, that's the phrase I wanted to use this morning, especially it's early in the morning here. I'm trying to get my head straight. The knee-jerk reaction might be to sell dollars, buy Aussies, buy euros, buy whatever. I've had an order out in the euro dollar overnight to sell euros at 118.22. I'm looking at the order right now. I thought it might reach for 118.25, just being a quarter number. But actually, I think the euro could reach all the way to 118.50. As if you guys read the ForexAnalytix analysis from this morning, okay, and I'm just gonna let you guys read that I wouldn't be surprised if we hit 118.50, being that is the 50% retracement and also the previous support. So I would hope, and this is what I'm hoping for, I hope we get a blowout number and we just spike we spike all the way up to 118, 50, and then that gives us all an opportunity to, short the euro there. That's what I'm hoping happens. I don't know if that's going to happen, but that's what I'm hoping happens. So, you gotta play into the idea that we'd have, risk on a strong number. Everybody sees the initial reaction. They're like, oh, great non-farm payroll number. We created almost 1 million jobs. You see a big spike up in risk, and it continues to squeeze the hell out of Credit Suisse and Nomura and Archegos. And then you see a little bit of a reversal. But anyway, that's just my food for thought as far as the price action today. So what I'm hoping that'll happen is that we get a spike up around the 118.50 level. I could take a short there and maybe ride it back down below 118, scalp in and out of it, going into the weekend. That's what I'm hoping to do today. So we'll see. One of the other things, if you notice how we closed yesterday at the highs at the end of the day, and some of you, if you're following me via Twitter, you might have seen my tweet, and it said it's Archegos out there or whatever it is. Do you know that end of the day, that's all that was, just like end of the day last week, the spike higher on Friday. I mean, this guy who was short, the Credit Suisse, the whole Archegos situation. I mean, that's just Credit Suisse and Nomura, and maybe even a little bit of Goldman and JP Morgan just getting out of positions at the end of the week. Isn't that crazy that one fund could drive price like that?
Yeah, it is. And, we've had situations where the market kind of creeps up, melts up on low volume, right? And it's not unheard of.
Yeah. And, as I've been, it's low volume. It's at the end of no one's going to stand in the way. Why would you stand in the way? Like I look at the S&P, and as I've said all week, hey, as long as we're above 38, 39.40, this has been us all week. As long as we're above 39.40, there is zero reason to be bearish. And matter of fact, we've been looking for 4,000. We went above 4,000. Actually, I wouldn't be surprised if we make it to 40.47 or 40.74. Excuse me, the 161% extension here. This is the top of the megaphone pattern too. I wouldn't be surprised if we make our way up there today, right up here. But you have to be careful, because this is a rise on very low volume, and we continue to see this big divergence. I'm telling you, so if we get up to here, Steve Stelios, I'm going to tell you right now, we get up to here. Not necessarily today. I think it'll be more like going into Monday or Tuesday of next week. Gosh dang it. I'm just trying to grab this damn thing. This is not working. I don't know why the settings here are all jacked up. I can't grab that thing. All right, I'll just keep doing that. Let's say we make it to 4,100 in the S&P going into early next week. As soon as we reach up there, I want you guys to take a guess what you guys think. And I'm going to answer this from DJ, but I want you guys to take a guess what I'm going to do if we reach for 4,100 early next week. What's the first thing I'm going to do? You guys take a guess. What trade am I going to take? And it's not in the S&P. So let me clarify that. DJ said one rumor is prime brokerage firms were trying to unwind in an orderly fashion. And one of them said, screw it. And then all of them tried to fit out the door at the same time. Yeah, that's exactly what's that's exactly what happened last Friday. And that's what happened yesterday at the end of the market. I mean, this end of the market, this is, you know, I'm gonna unwind. Yeah, let's all do this together. You know, let's be cordial about this. And then at the end of the day, screw it. You know, get out. And then everybody's trying to get out at the end of the day. And it's just it happened in the S&Ps. It happened in the NASDAQ. You know, it's just this is all same thing last week right here. You know, same difference. Right there. So the question, and somebody said sell NASDAQ. Actually, that's probably not a bad idea to sell NASDAQ. If you really want to short one of the markets with yields going higher, short NASDAQ, short growth. Don't short value. Don't short the Dow. Don't short the S&P. Short NASDAQ if that's what you're going to do. But that's not what I'm going to do. The first thing I'm going to do, we hit 4,100 in the S&P. I'm selling Aussie dollars, and I'm going to hope that the Aussie dollar is trading right here.
Or buy dollar Norway.
Yeah, you buy dollar Norway.
We have a lot of good answers there on the chat. Well done, guys.
Yeah, I mean, you guys, that's exactly what I'd be doing. Buying the dollar Canadian, hopefully right there for an inverted head and shoulder pattern. Buying the dollar Mexican peso, hopefully just sub 20. There's a lot of things that I want to do. Please let the S&P get to 4,100. You guys can try to trade these yen pairs. I don't know what to do with the yen pairs, to be honest. I was talking to one of the traders in our chat room last night in Asia, and one of the things about the DSI is at such extremes right now. The yen DSI is at like 10, I think. So what that means is, you know, buying yen is not a bad idea right now. I did note that on the euro yen that we're up against this multi-year trend line. I'm hoping that, matter of fact, I'm hoping we get some risk on as soon as this jobs data comes out and it squeezes out us above the euro, the highs here, and then I can get short. That was one of the comments that I was talking to JT in our chat room last night in Asia about that. It's like, yeah, the DSI is so extreme right now that, you know, you got to play into it, you know, from a counter trend point of view, especially when you're up against, you know, pretty key levels. I don't know what else I would want to short. I don't want to short the Aussie or the Kiwi yen or the Canadian yen yet, because I'd rather have exposure with those against the dollar. And I don't want to short the pound yen because it's, you know, it's already showing it's breaking out, and the sterling's been, you know, pretty stout. And the dollar yen is obviously in breakout territory. You know, it's in multi-year breakout territory. So this is the one, you know, that's the thing that makes me a little nervous, is this particular chart. But I wouldn't mind, you know, taking a pot shot at it above highs on that euro yen. But going back to my other comments is, yeah, if we got to 4,100 in the S&P, I'm going to be selling some of these commodity currencies. That's exactly what I'm going to be doing. So hopefully give you guys some actionable ideas over the next couple of days, give you some things to think about. We are just a few minutes away from the jobs report. And I want to thank all of you guys for being here. There's a lot of you in here, and a lot of you that are listening in. If you guys are listening in via YouTube, do me a favor, click the thumbs up, chat in the chat box, you know, tell Blake he's an idiot, whatever you want to do. You know, and I know a lot of you will, so that's fine. But yeah, that just, you know, helps our YouTube stance, if you will. We made some tweaks on our YouTube channel over the last couple of weeks. And so your help is greatly appreciated, and the thumbs up and all that kind of stuff. And also subscribing to the channel as well. And so Steve Stelios, any last minute comments? Steve, you've been pretty quiet today. Any last minute comments before we go into our jobs report here?
You were a typhoon. I mean, I don't want to interrupt you.
I appreciate that, Steve. You usually you have no problem interrupting me. So
yeah, I was going to say, yeah.
What happened? Did you? What happened there? You drinking alcohol now?
Oh yeah, tons and tons of alcohol.
You're just drunk as could be. Steve doesn't drink, guys. So for those, and you know,
no, I do an occasional, glass of wine, but very, very occasional.
Right.
It's not that I'm against alcohol, just not my cup of tea, as they say.
I see. Yeah, but I don't know what the setting is here. It's killing me. It's like stay in drawing mode. Okay, let me do that.
DJ says Uzo. No, actually, I actually don't like Uzo.
Uzo.
I don't even like
for
beers.
Those that never had.
I'm
Uzo,
weird.
I'll tell you, it tastes like peppermint schnapps is what it tastes like. But just on a very, very, very strong. So we're seeing a little spike up here ahead of the jobs data, and like the dollar max is starting to spike higher. Remember, strong data today, the initial reaction might be to sell dollars. It might be, I'm hoping, that it might be to sell dollars on a strong piece of data, but that doesn't, I would use that as an opportunity to buy dollars on any dip on a strong piece of data. If we miss, we haven't even talked about missing. What happens, Steve Stelios, if the data comes in and let's say we only create 100,000 jobs, and if we're looking for 650,000, people are thinking a million. I personally think that means stocks go
up.
Stocks go straight up, and people are going to go, man, the Fed's going to keep it easy for the next 14 years.
If we miss, I think it's a continuation of what we've seen for the past years, right? The same thing. The question is, if we beat, and what we're trying to find now is a signal that something's going to change. That's what we really want. And I think a strong jobs number, a really strong jobs number would be a good start.
Right. Yeah. So, I mean, because
I actually think there is a chance that very good or very bad data are equally bad. News
for who?
Yeah.
Oh,
for what?
For what?
Yeah, for speaking about the dollar now, right? Meaning, what I'm trying to say is that I think if we continue more or less with what's expected, then the market has the safety that the Fed is on path, and on the other hand, that the economy is not in danger of getting derailed. If the data is very good, mistakenly, because I've said my opinion before, I don't think the Fed is going to do anything. So I disagree with that, Blake. But mistakenly, market
wait, I'm sorry. I was drawing. I was drawing.
I think that contrary to what people believe, the Fed is not going to be forced to raise rates, even if data keep coming up improved. I'm not going to say good because data are nowhere near good. So I think that both good news and bad news are probably going to be treated more or less the same. I know it sounds weird. I think the best for
numbers
assets,
coming out now. Coming out now.
I think the best for risk assets is coming
916.
916. That is a strong number.
Yep.
Woo!
And a strong revision as well. Oh, strong green revision.
Wait, and you know what? Stocks are going straight up, and I think you have to sell into that strength, believe it or not. We are seeing the dollars.
Average hourly earnings lower. Average work week higher. Manufacturing payrolls substantially higher.
Look at futures. So futures spiked up, and now they're going to come right back down. Just that's would be my assumption is we spike up and then we come down on that strong data. You can see the dollar Canadian's moving higher. The euros just kind of flip-flopping around, not really doing a whole lot.
Yeah, we're seeing volatility, but no direction yet.
But look at the Dow. The Dow's up, the NASDAQ's down. So that means yields are going higher. well, the bond market's closed. What am I talking about? I'm like, wait. But the market would assume the yields are going to go higher. That's why the Nasdaq's under pressure and the Dow's up. Dow's at new highs. Euro's just kind of sitting there. Cable's, a little weaker. Aussie, Kiwi, just kind of sitting there too. Dollar Canadian.
Currency's not moving much, are they?
Yeah, for the time being,
waiting for Monday or Tuesday, actually.
Yeah, well, for the time being, we've seen a little bit of a whipsaw, but no direction yet.
Yeah. But this has
anyhow, what I was saying, Blake, is that I think that for risk assets, and of course the opposite applies to the dollar because we know the general inverse correlation. I think that really good news might end up being bad for risk assets because many market participants will believe that the Fed might start considering tapering. I think they will not. But doesn't matter what I think because I'm not the average market investor. So, what matters is what most will be doing. But I also think that if we start seeing really bad data for some reason, that's also going to be bad. You know what I mean? Because then the market starts thinking, okay, we've had all this stimulus, we've been having all that easy monetary policy, and it's not enough. So, what happens? So for risk assets, I think that the best path forward for people that are long risk and, they believe risk is going to go much higher, which I think it's a very good chance. The best path forward is to get data steadily, slowly improving, but without any, real breakthrough, jump in a positive way. So that's what I think is the case here. So
by the way,
very good data and very bad data.
Stocks are ripping right now.
Yeah, I think very good data
all the way around. Sorry.
Yeah,
go ahead.
I think very good data and very bad data will end up being bad for stocks. In general, that's what I think. And for the time being, we've seen.
I think a lot of the moves that you're seeing in stocks in the futures right now, it probably continues to be position unwinding.
And don't forget the very low liquidity conditions today, right? So I wouldn't be surprised if whatever happens today, if we end up having some movement, gets completely retraced on Monday. I wouldn't be surprised at all.
Yeah, I don't disagree with you there. The currency market's really not moving right now, and we're going to be calling it. We're going to be pretty much calling it a weekend here in a few minutes here at ForexAnalytix. Because obviously everybody's out for Good Friday and the weekend, and hell, half of our viewership is gone, as they should be. I mean,
of course,
if you're here right now, let's face it, you're a junkie.
Get a life.
I mean, yeah,
get a life.
You got a problem. I'm just kidding. I got a problem too. I'm obviously kidding about that. But only the hardcore are here. That's what I'm saying. And we all might have a problem, but for the rest of you guys, just keep in mind that the market is very illiquid right now. And by the way, the dollar Mexican peso is coming back down, getting slammed right back down again. Again, this is lack of liquidity and futures are up. So emerging market currencies are firming here. Here's the Rand is starting to firm a little bit too. I don't even look at the Turkish lira. This is one of those things though, man, this is, look at the longer term of this, the Turkish lira. It's crazy. Anyway.
I wouldn't be surprised if we're forming there another cup and handle formation to go to new highs.
The Turkish lira. Could you imagine?
Yeah.
I mean,
look at it.
I know. No, this literally could be the next Argentina situation, right?
Oh, absolutely.
I mean, I don't know if you guys, can, just keep an eye on this. But.
Although I have to tell you, and I've said it before, and people might misunderstand because I'm Greek. First of all, I have many Turkish friends. Second of all, I have nothing with Turkey. Keep in mind, Blake, I'm going to be the first one buying the Turkish lira, both hands, once there is some political normality and some normal politician is in the wheel. Because keep in mind that Turkey has on one of the most important elements for an economy and the most rare shot nowadays, an amazing demographic situation, very, very young population. And that's always positive for an economy. It's probably the most important element, but they need to have some normal economic policies in place to take advantage of that. So at some point, I think there is going to be an amazing opportunity to be long the Turkish lira. But as long as Erdogan is doing, whatever comes on his head, I don't think that's going to be the time.
Yeah. All right. Well, so the day he, let's just say he, I never want to wish this on anybody.
The day he gets replaced for one reason or the other, we don't
let's
have
say
to.
he has health issues and he's
whatever.
He's
I think it's going to be massively bullish for the Turkish lira and the Turkish economy.
Interesting. Okay. All right. Hey, by the way, the dollar has weakened pretty good against. We've got this is one of those situations. You got the Dow moving higher, the Nasdaq floundering, and the S&P is moving higher. Everybody's thinking, okay, bond markets are gonna, when they open, yields are gonna rip higher. The dollar's moving a little bit lower right now. The euro's just kind of flopping around. It's near its highs of the session. Dollar Mexican peso's at its lows. Dollar Canadian has slipped. So we're going to see this. We're going to see this move in yields, and I guess the market likes it. So at what point? What point does the market not like it?
I think this type of trade is going to have a very short leash, Blake.
What do you mean?
I mean that the yields go up, it's fine. Type of correlation can't last for much longer.
Oh yeah.
We'll see about that. I hear what you're saying. I hear what you're saying. I don't know if I don't
know exactly what's going to be the breaking point. I mean, I can't tell you it's going to be like 1.85 or 2%, which is like a nice rounded number and the psychological number or whatever. I mean, whoever thinks they can make that type of a prediction, I think they're fooling themselves. Although, admittedly, 2% sounds like a good number because, it's a psychological level as well. But I'm pretty sure that, at some point, the market is going to wake up and say, if we keep seeing yields creep high, wait a second. I mean, we're going to be running for a second consecutive year, massive deficits, and debt is exploding higher, while I need to remind everybody, the average maturity, the duration of the debt keeps decreasing and decreasing, meaning that the interest payments are extremely sensitive to changes in interest rates. Back when Volcker had to hike rates to 20%, the US economy had a much longer duration to its debt. So Volcker might have hiked to 20%, but the effect was not that great to the debt because the US debt had in general much longer maturities. Now the vast majority of the US debt is very short term, meaning that yields going higher have an almost immediate effect in debt repayments and the cost of repaying the debt. So it's a horrible position to be in if interest rates keep climbing higher. Because in essence, it's going to lead to a vicious circle that you're going to need to monetize even more debt just to pay the big repayments, which exacerbates the problem even further. And once you go into a death spiral like that, and the markets wake up to this reality, it's going to be really bad. That's why I think they're not going to let it happen. I mean, they're going to.
I want to add one thing in terms of yields. The problem we have is that it's only US treasuries basically and yields that are going up, right? You have 10-year bonds at minus 45 base points, whatever. You have 10-year gilts at close to zero. So when you get the US 10-year US going to 1.5, 170, 182%, the search for yield and in relative value terms, you're going to get lots of buyers.
I doubt it, Stelio.
Well,
I wanna remind you that
I've seen money managers work, and you know what? Sometimes this this
I
yield you
don't
really
doubt
really
that.
want it.
But I just want to remind you that last time I checked, I think it was like a week ago, 10 days ago. It was rather recently. The yield differential between tips, so the implied, in essence, inflation, so I don't make it very technical, was 2.4%. So imagine the actual bond market, which is manipulated because for some reason, God knows what reason that is, because it makes no theoretical sense. You know that the Fed also buys tips, which I really don't understand. The Fed should not be buying at least tips, because that is a market made to supposedly hedge your exposure to currency depreciation or whatever. So they even suppress that market. But even by suppressing that market as well, the yield differential implies an inflation of 2.4%. So in order for somebody to want to take the risk of being in a foreign currency, if we're talking about people outside the US, we're going to have to see yields being at least that high. Otherwise, they will be risking currency depreciation and losing part of their money to collect less income than they will actually be losing.
They're gonna be hedging with FX forwards and stuff. They're gonna be hedging with whatever, and they don't have to hedge. They buy 10-year treasuries and they're not hedging 10-year FX risk. So it's something, this yield differential and this place where they can find some yield with relative safety is a big power that draws to them. I think we're going higher in yields, but I'm just saying that there's a lot of money managers, and basically there's a lot of people who are going to be buying just for the yield. But anyway,
let's see. I think if they do that, I think they will be doing a very big mistake.
Yeah, I'm not saying if it's right or wrong. I'm just saying I think it's going to be something that we're going to be seeing, and it's going to.
I think it's going to be prove to be a very, very, very bad decision.
Yeah, that's a different story. Yeah.
I'm sorry, I was in the middle of drawing. At what point do they pull the yield curve control card?
Who knows?
To be honest, I've said it before. I think the yield curve control is just a euphemism and like psychological type of event that won't have. Will probably have an effect for psychological reasons, but not really a practical event. Because as far as I'm concerned, I don't think.
Wait, real quick before you continue. You don't think there's going to be any market reaction to?
Oh, there will.
Some sort of.
There will. Initially, there will be a big reaction, but I think
the dollar will get creamed. But
yeah, I think the market will soon realize that it's not much different to what they've been doing so far. Just to give you an analogy, Blake, you remember that. Before we got COVID, they started doing QE, but they didn't want to admit that it was QE. And everybody was making a joke that it is the non-QE QE. So, I mean, the analogy is that I think that yield curve control is going to be exactly the same thing. I mean, they're going to announce yield curve control. The market is going to react initially. And then the market is going to realize that yield curve control is more or less what they've been doing so far. They just didn't officially say that this is what they were doing.
Yeah. I think it's gonna be an interesting dynamic when that's enabled. By the way, the market is just continuing to squeeze. What time does futures close today? I think it's at, if I'm not mistaken, it's at 9:15 Eastern, which would be my time would be 6:15 in like 30 minutes. If I'm not mistaken.
Might be the case.
Yeah, I think that's what's happening. Currencies will obviously still be moving. The currency market's just very quiet. Even like like if you just take a real quick look around in the currency market, and we'll take a look at what equities are doing. The euro's just still maybe five pips away from where it was, pre-data. The cable,
By the
same
way,
thing.
Blake, since you were talking about equity markets, I think one of the biggest technical developments yesterday was the breakdown in VIX. I don't know if you had a look at the VIX yesterday.
Yeah, we were talking about it with Dale. We actually closed the gap, and the VIX is finally breaking down. Now here's the thing I have to mention. We filled the gap finally. This is the lockdown gap fill. The volatility, the daily sentiment on VIX right now is at 11 or 10. It's really low. So I actually expect volatility to spike up early next week, which, obviously the only reason and the only way it could really do that is with some risk aversion. So, I think this breakdown that you're pointing out, Steve, has gotten a lot of people excited.
Oh yeah,
a lot of fresh shorts coming in. That's like been one of the biggest trades of the last several years, has just been, selling volatility. And so when you've got every portfolio manager out there shorting VIX aggressively as it's been perched up all of, the last 12 months, I think the aggressive shorts right now they're going to end up being late to this game. And what's going to happen, I think, early next week is we're going to spike right back above 20. And that's going to create a little bit of reversal in risk assets, in my opinion. But anyways, sorry, Steve, that was just my opinion.
One of these appealing trading strategies that makes you money 99% of 100 days of the year, 95, let's say, days of the year, of the 100 out of 100 days. And then something happens, and within a couple of days you blow up.
Yeah, and you know what? And the funny thing about that is, Steve, and it's interesting you bring this up. This is the trade that hasn't worked all year for most portfolio managers. Think about that.
Yeah, although don't forget, because it has a contango, you still make money being short VIX if it doesn't really go up. So even if it stays more or less range bound, you still make money.
Right, but what I'm trying to say is
it hasn't worked like amazingly, but more or less it has been working.
But what people keep doing, and I've seen it time and time again, is people keep shorting into this when it breaks. So when it breaks, people get short and then they get squeezed out. And then they, it starts to break down again. People go, oh my, here we go. We're gonna slip back below 20, and then it spikes up again. And we're gonna roll over again, and then it spikes up again. Then it's gonna, here we go. We're gonna break down, and then it spikes up again. What I'm saying is, a lot of people have been trying to say, this is the move. Like right now, this is the move. I'm getting short, and then they get their ass handed to them a couple of days later. That's just, it's been that has been the trade of end of 2020, beginning of 2021 for like.
Speaking of which, just to put things in context, within the past year exactly, we've rallied more than 80%. Can you just imagine that?
Oh, are you talking about the S&P?
Yeah.
Oh no, my daily roundup yesterday, which by the way is only a ForexAnalytix subscriber video. You can listen to it after the fact. So you can go to YouTube right now and actually listen to our daily roundup. But I spent a half an hour talking about the S&P and just how, because the market was kind of slow yesterday, I was just flabbergasted by how we've basically almost doubled. I mean,
yeah, it is unbelievable
in a year. And one of our listeners and one of our clients, Amira, is like, it's not that amazing. I mean, and I'm like, since I've been around, that's pretty amazing. And I've been trading since, 1996. So
the most amazing part is that it has almost doubled from the lows, and the economies are in really, really bad shape. They were in bad shape, and they are at much worse shape following COVID, because they threw everything, including the kitchen sink, to like help out with the situation. But for some reason, people keep forgetting important stuff, like the US posted its biggest trade deficit good. I think they're calling it nowadays merchandising deficit. Last month, ever in its history. Unemployment, unemployment claims still are coming week on week, worse than during what was called the Great Recession, because it was the worst recession after the Great Depression. So theoretically speaking, we are where we are, and we still get unemployment numbers worse than at the worst week we had during the 2008-2009 crisis. The debt has exploded higher, and it's like none of that matters. You know what I mean? It's like the money we used to fight all the damage COVID brought to the economies. It's like it was gifted from like aliens, so we never have to pay back for them.
I know. That's funny. Gifted by aliens. I like that.
Yeah, I mean, you know.
Anyway, well, I'll tell you, it just, this gives you an, you can put it on a log scale if you want, but you can put it on an actual scale. That's when I started in the business, started trading. I actually started in the business a good year and a half before this. But that's when I started trading, and I've seen a lot, and I've seen markets, I was talking yesterday about, even the financial crisis. Let's talk about the housing financial crisis, the big GFC, right? We lost, the market was down 60%, right? And then it took, I want to say 3 years from, the 665 level, well, actually to 1200. Yeah, it took, what was that, like 2.5, 3 years to double? I mean, we basically have doubled, and the moves have been massive in a year, right? So, the S&P has rallied quite substantially since the financial crisis, of course, but man, this is all engineered. It's just all financially engineered, and it's nuts. I mean, it's really wild to see where we're at now. And the thing that makes me the most sad actually about all this, I don't know how much time I've got left on this earth. I'd like to think I've got another 50 years, but in all actuality, it may be somewhere between 20 and 40 years, right? And I think a lot of this is robbing the future generations of potential gains in
for sure,
in
especially
equities.
in real terms.
Yeah, in real
because
terms,
nominally speaking, who knows? I mean, it might go a lot higher, but it doesn't really matter what the nominal price is. What matters is what the real purchasing power of S&P is. You know what I mean?
Yeah.
And
I don't
if
know.
you want to have if you want to have a fast glimpse of what the real purchasing power of S&P is, go there, Blake. Go at the ticker area on the top left, and divide the SPX, divide it by gold. No, just use backspace and use the division. Yeah.
Like this?
The division signal, it's on your right hand side.
Oh, okay.
Yeah. And divide it by gold. XAU USD, yeah. Doesn't really matter, spot gold, whatever.
Yeah.
Enter.
Yes. Oh, I wasn't doing it. I was trying to click enter. Yeah. So why don't you explain to everybody what they're seeing here?
It's the value of S&P in terms of real money, because in my opinion, gold remains, the only tangible way to measure real purchasing power. It's not by accident that if you measure the vast majority of important and expensive items, you'll see that in terms of gold, the price hasn't really changed since, let's say, World War II. It's not coincidental. So if you look at the S&P in terms of gold, it is so far away from its highs.
Yeah. Well, the flip side of that is if you live here in the United States and you have US dollars and I make money in the stock market and I own stocks and I own Tesla and I sold it and I've tripled my money. I'm not going to Greece. I'm not going to Mexico. My real
Yeah, but
terms
on
are
the other
in
hand,
dollars.
but on the other hand, you need $1,000 per month for your personal insurance. Question: how much did you need 25 years ago?
Yeah, right. Right. That's
Right?
true.
Because now we're talking purely in dollar terms. How
Yeah.
much money would you need to send your kids in college 25 years ago, and how much do you need today, Blake?
Right. Now that's good.
Steve, that chart you had Blake put on there, it just tells you that stocks can go a lot higher now.
Absolutely, in nominal terms, I'm totally with you, Stelio. In nominal terms, they can go a lot higher. I totally agree.
Yeah.
And it probably will too, in all actuality. So, all right, guys. Well, hey, with that being said, I want to say, thank you all for joining us for this Good Friday special edition of the FACE webinar. Keep in mind that we do these webinars a couple times a day for just ForexAnalytix clients. Typically, we'll do, and it's not going to happen today. So, for those of you that are ForexAnalytix clients, we are not doing the morning edge, which is actually usually 15 minutes from now, where we go through all the charts and the market's going to be dead from here on out. So it's enjoy your weekend. But if you want to be part of ForexAnalytix, try us out. It's only $1 for 10 days. And then after that, even if you're a light version at $19 a month, you can still listen to all the webinars that we do. But the premium version actually gets you in the chat room, and that's where you're going to find
and the patterns in play
and the rest of the team. What's that?
And the patterns in play.
And the patterns in play, correct. Yes, correct.
And the harmonics and Elliott waves analysis.
And the advanced analysis, the patterns in play, and all the different trades that we do. But really, the patterns in play are great to help give you a bias. I had somebody ask me yesterday about like, how do I use these? Especially if I'm not around when they're triggered. It's like, well, use them for more of bias. If I've got a pattern in play long euro dollar, then maybe it's telling you, hey, Blake's looking for higher prices in the euro, and then you can factor that into your decision making. But we have things like that. But most of the trading that like the positioning that I'm taking intraday, we're going to talk about it in the
also chat. Since you mentioned the plans, let's not forget that people can also enroll for the programs. We have the sponsorship programs if they're outside the US and Canada with Pepperstone, otherwise with Forest Park FX. And this way they either get 2 to 4 months of free premium account, or otherwise if they're in the US and Canada, they can substitute their subscription with the cashback they get through their trading. So it's, especially, for example, for people that are in the light program, they can extremely easily make the cost of it, just by their trading.
That's right. See, I mean, if you guys are in the US and Canada and you're not getting paid cash back rebates,
you should.
You should be.
Yeah,
so
absolutely.
Yeah, you should be. So, all right, guys. Hey, I want to leave it at that. You guys have a great one, and have a great holiday weekend. We'll see you fresh here on Monday after the long holiday weekend. So have a great one. All right.
Thanks, everybody.
Thanks, guys.
Have a wonderful holiday. Bye-bye.
Happy holidays. Talk to you later. Bye-bye.